So when it comes to arbitrage pricing model, we shall be looking at the same issue to do the CAPM, but now after that, there will be many more other factors. The other two models we added, there were only 4 factors to include. But now for this one, there can be any other many factors which can be factored in order to determine whether that particular portfolio will be able to give you the required returns. So let us write something brief about the arbitrage pricing theory. We can summarize that this model was developed. This model was developed due to the limitations of CAPM. This model was developed due to the limitations of CAPM. It was developed due to the limitations of CAPM. It is a multi-factor model. It is a multi-factor model. It is a multi-factor model which assumes that apart from the market, comma, there are other factors. There are other factors which influence the returns of the security. There are other factors which influence the returns of the security. There are other factors which influence the returns of the security. Then we continue by writing that this model is based on the following assumptions. This model is based on the following assumptions. This model is based on the following assumptions. Number one is that there is a perfect and efficient capital market. Number one is that there is a perfect and efficient capital market. There is a perfect and efficient capital market. Number two is that the returns of a given security, is generated. The returns of a given security is generated through continuous trading. The returns of a given security is generated through continuous trading.
Yes.
Trading.
To trade.
The continuous trading. And the last one, number 3, is that investors prefer more returns. Investors prefer more returns. Investors prefer more returns. Then another paragraph, we summarize that this model argues that there are several factors. This model argues that there are several factors. Known as systematic factors. Known as the systematic factors or sensitivity factors. Known as the systematic factors or sensitivity factors, which influence the security returns. Which influence the security returns. Which influence the security returns. And they include market index, comma, interest rate changes, comma, inflation, comma, political risk, comma, energy crisis, comma, factors of production, etc. Factors of production, etc. Then a new paragraph, we summarize that. Under this model, comma, the beta factor is also known as, the sensitivity factor. The beta factor is also known as the sensitivity factor, or the systematic factors. The sensitivity factors or systematic factors. And it is possible to identify, the beta factor. It is possible to identify the beta factor for each. It is possible to identify the beta factor for each of the factors. For each of the factors affecting the returns of the security. For each of the factors affecting the returns of the security. For each of the factors affecting the returns of the security. Then another paragraph, we summarize that under this model, comma, the returns of the security can be expressed as follows. Under this model, the returns of the security can be expressed as follows. The returns of the security can be expressed as follows. So, the return of the security will be equal to, so the return of the security will be equal to the risk-free rate, then plus in brackets, expected return for factor 1 minus the risk-free rate, the beta factor for factor 1, then we add expected return of factor 2 minus the risk-free, the beta factor of factor 2, then plus also expected return of factor 3 minus the risk-free rate, then the beta factor of factor 3, the beta factor of factor 3. So we can also include there any other factors. Expected return for factor n minus the risk-free rate, then the beta factor for factor n. So n is any other factor. So n will be any other factor. N. So this one are many factors that can be included. There are simply many factors that can be included. So we are to look at a question, November 2019, question number 3, part C. We can check through the question for November 2019. Question number 3, part C. November 2019. There is a question number 3, part C. November 2019. So it is on page 33. It is on page 33. So on that page 33, question 3, part C, they said that Jacob Ocheng, an investor, believes that, page 33, believes that there are 3 important factors that determine the expected return of a particular common stock. So Job uses the following factor betas and the factor risk premium. So they gave you factor 1, factor 2, and factor 3. Then the beta factors and risk premium. So the risk-free rate was given us 5%. So required the expected return from the stock using the arbitrage model. So this one has only 3 factors. Factor 1, 2, up to factor 3. So we shall have it like that. So also remember this region. We say it the same as what? This premium. So now, for us to get the return for that security, risk-free rate has been given us 5%. Then you see the risk premium for the first one, 2.5. And what is the beta factor for the first one? 0.7. Then we add. The next factor is 5. The risk premium is 5. Then what do we have as the beta factor? 1.20. And the last one is 6. Then the beta factor is negative what? 0.1. So that now will give you the expected return for that factor. So those who are going for the prayers can just go for the 5 minutes.
Anaenda naye bila wengine kusanya.
Okay, which here? So we can now get another question. We should now go to another question. So this one should be December 2014. December 2014. Question number 2, part B. December 2014. December, it is page 70 what? Page 79. So December 2014, question number 2, part B, which they have said it is on page 79. So it starts, just on page 79. Question 2, part B, but it is indicated there as A. It is indicated there as A. So that page 79. So it is on page 79, where they have said that an investor is considering investing in the stocks of 3 companies. An investor is considering investing in the stocks of 3 companies. That is A Limited, B Limited, and C Limited. So the following information relates to the stock of the 3 companies. Relates to the stock of the 3 companies. So you are given company A, B, C. So sensitivity of the stock returns to the changes in. So those factors are beta factors. Sensitivity factors are the same as the beta factors. The sensitivity factors are the same as the beta factors. So they gave you for A, B, C, like that. So we are checking a question for December 2014, question number 2, part B. So it is on page 79. When you go to page 79, you trace the question. So during the year 2014, it is expected that market index will increase in performance by 2.5%, up from its current 5%. Up from its current 5%. The risk-free rate of return in the market will be 6% on average, and inflation and economic growth will be 10% and 5.6% respectively. But now required, Roman letter 1, the expected return for the 3 stock in the year 2014 using CAPM. Roman letter 2, expected return for the 3 stock in the year 2014 using the arbitrage pricing theory. Then finally, they wanted you to state the reasons why investor will get different return under part B, Roman letter 1 and Roman letter. So we start off with the Roman letter 1. So Roman letter 1, they have said CAPM. When we use CAPM, we say that it is only the market which will influence the returns of the security. When we use CAPM, it is only the market. So what we do under CAPM, so under CAPM, so we want to start with the one for CAPM. We start with the one for CAPM. So when we are using CAPM, the return of the security will be given by the risk-free rate plus, in brackets, expected return for the market minus the risk-free rate, then the beta factor of that market factor. The beta factor of that market factor, or simply the security. So when you go through the question, they gave you some details towards the before required. During the year 2014, it is expected that the market index will increase in performance by 2.5%, up from the current what? So that is expected return for the market. So to get the expected return for the market, you take 2.5 plus 5. That will be 7.5. Then they continue to say that the risk-free rate of return is given as what percent? 6%. So we are not interested about inflation or economic. Here we are only dealing with the market. We only deal with the market. So we start by computing the return of A. We start off by calculating the return for share A. Return for share A, risk-free rate, they have said it is 6%. Then we add expected return for the market. Expected return for the market. We have said 5 plus 2.5 is the same as 7.5. So we minus the risk-free rate, which is also again 6. Then the beta factor. You see the sensitivity factor at the bit. So we use only the ones for the market. For A, the market is given as 1.5. So we do the same for return for B. Also B6 plus in brackets 7.5 minus 6. So the beta for this one is 0.9. We also compute the return. The risk-free rate will not change. The expected return for the market will not change. The one that is changing is the beta factors. So you do the same for the return of C. It is 6 plus in brackets 7.5 minus 6. So that beta factor is 1.1. So that is when you apply capital. Yes. So if they say that the market is representing the return for the market. That's why it becomes a beta factor. But for the beta factor, they are not percentages. The returns are the one which are percentages. That's why for this return for the market, the 7.5 is a percentage. The 7.5 is a percentage. So that should now be for CAPM. So we go to Roman letter 2, arbitrage pricing theory. Roman letter 2 is now the arbitrage pricing theory. Arbitrage pricing model. So when it comes to the arbitrage pricing model, the formula will remain the market. Apart from the market, there are other factors. So the one for the market will remain. Now we factor in the inflation. There is market, inflation, and economic growth. So we include there expected return for inflation and minus the risk-free rate, the beta factor for inflation. Also, expected return for economic minus the risk-free rate, the beta factor for the economic. So now there are 3 factors: market, inflation, and economic growth. The market, inflation, and the economic growth. So when it comes to arbitrage pricing model, apart from the market, there are many other factors which influence the return for the security. So for this question, they have given you inflation and economic growth. Now we include it now on the market. So if you go through the question, they gave you some details. When you go through the question, they have given you some details. So those details, they gave you the risk-free rate was 6% on average. You see, before required. And inflation and economic growth will be 10% and what? 5.6. So we shall just expand these ones. So this one I include now the one for inflation. The one for the inflation for the market, it remains the way we have it. Now we factor in inflation. So when it comes to inflation, they gave you, is it 10? So that one is 10 minus the risk-free rate, which is 6. So the beta factor for inflation is negative 0.1. Then for economic growth, you see the 5.6. Yeah, so you take 5.6 minus the 6. The beta factor for that one is 0.56. So that now will be for A. Then for B, we repeat the same. 10 is not changing, 6 is not changing. The other one is 0.1. Then 5.6. This one. So that should now be your Roman letter 2. So now we need to go to Roman letter 3, where they want to state the reasons why investors will get different returns estimated in B, Roman letter 1 and B, Roman letter 2. So instead of giving the differences, because it is the same as the part A of it. So that part we have answered is part B, but it is indicated there as part A. So I want you to check the one that discuss 3 consumption differences is supposed to be A. And here you tumefanya in part B. So instead of getting the reason why they will give us, so let us first look at the differences between CAPM and arbitrage pricing theory. You'll get to know now the reason why the two are different. So we can look at the differences between CAPM and the arbitrage pricing theory. We can look at the differences between CAPM and the arbitrage pricing theory. We can look at the differences between CAPM and the arbitrage pricing theory. So you can have one side CAPM, the other side arbitrage pricing theory. You can have one side CAPM, the other side arbitrage pricing theory. One side CAPM, the other side the arbitrage pricing theory. So on the side of CAPM, number 1, we write that it is a single factor model. So on the side of CAPM, we summarize that it is a single factor model. It is a single factor model. On the side of the arbitrage pricing theory, we summarize that it is a multi-factor model. It is a multi-factor model. There are more than one, but the other one, it was only one factor. Number 2 is that on the side of CAPM, it assumes that there exists a well-diversified portfolio. It assumes that there exists a well-diversified portfolio. So there exists a well-diversified portfolio. Then on the other side, we also write that it ignores the assumption of a well-diversified portfolio. It ignores the assumptions of a well-diversified portfolio. It ignores the assumption of a well-diversified portfolio. Then number 3, on the side of CAPM, we write that it is a single period model. It is a single period model. A single period model which is applicable for the short period investment. It is a single period model which is applicable for the short period investment. For the short period investment. Then on the side of the arbitrage pricing theory, we write that it can be extended to multi-period framework analysis. 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 Then number 4 on the side of CAPM is that it uses indifference curves. It uses indifference curves in determining the utility of the investor. It uses indifference curves in determining the utility of the investor. It uses indifference curves in determining the utility of the investor. On the other side, we say that it does not use the indifference curves. It does not use the indifference curves. It does not use the indifference curves in estimating the returns of the security. It does not use the indifference curves in estimating the returns of the security. In estimating the returns of the security. In estimating the returns of the security. Then the other one is number what? It is considered to be less general. It is considered to be less general and unrealistic. It is considered to be less general and unrealistic. Since only one factor will be used. It is considered to be less general and unrealistic. Yeah, and unrealistic. Since only one factor will be used to analyze. Since only one factor will be used to analyze the systematic risk. Since only one factor will be used to analyze the systematic risk. Then on the side of arbitrage pricing theory, we summarize that it is considered to be more general and realistic. It is considered to be more general and realistic in estimating the returns of the security. It is considered to be more general and realistic in estimating the returns of the security. In estimating the returns of the security, since it considers all the factors. Since it considers all the factors that would cause systematic risk. Since it considers all the factors that would cause the systematic risk. Then the next one on the side of CAPEM, we write that it assumes that there is a normal distribution of returns. It assumes that there is a normal distribution of the returns. There is a normal distribution of the returns. And on the other side, we write that it assumes that returns are generated through continuous trading. It assumes that returns are generated through continuous trading. They are generated through continuous trading. So that is now the differences. So those differences, you can use them to explain why they say that. You see that from letter 3 of the same question is state reason why an investor will get different returns in B, Roman letter 1 and B, Roman letter 2. In fact, it is just one major factor. Under arbitrage pricing theory, there are other factors apart from the market. But under CAPEM, it is only the market which estimates the returns of this. That's why we get those different returns. So that is now the conclusion in relation to CAPEM and other models of dealing with the risk. So now we shall start a new topic. Now we start a new topic. So the new topic will be financing decisions. Our new topic will now be financing decisions. So we got the financing decisions. We got the financing decisions. So when we shall be discussing about financing decision, we shall be interested in the cost of capital. We shall be interested in the sources of finance. Then from there, we shall be able to compute the weighted average cost of capital and the weighted marginal cost of capital. So financing decisions are simply concerned about, so we can write something about the financing decisions. So we can summarize that our decisions which involves commitment of the funds. which involves commitment of the funds in the long-term projects, commitment of the funds in the long-term projects, Hence, it will involve evaluating the projects. Hence, it will involve evaluating the projects and determining the sources of finance. Evaluating the project and determining the sources of finance for the new investment project. Sources of finance for the new investment projects. So that's now what we mean by those financing decisions. So apart from that, let us now write something about the point of indifference. Let us now write something brief about point of indifference. And the point of So when it comes to the point of indifference, it is just the point of financing where earning per share for the options available are the same, and also earnings before interest and tax for the two options are the same, so that you are unable to select a given option. So our interest is the earning per share. Let's say for option 1 will be the same as earning per share for option 2. Also, earnings before interest and tax for option 1 will be the same as earnings before interest and tax. Earnings before interest and tax for option 2. So that's what we mean by the point of indifference. It is simply that point of financing where earning per share and earnings before interest and tax of all the available financing options are the same, so that you are not sure which option to use. That's why we say we are now indifference. But for now, we can start by summarizing that it is the point of financing. It is the point of financing. It is the point of financing where the earning per share, and earnings before interest and tax, where the earning per share and earnings before interest and tax, of all available financing options, are equal. Of all available financing options are equal. And therefore the investor is unable. To select a given financing option. And therefore, the investor is unable to select a given financing option. So we are saying that it is the point of financing where earning per share and earnings before interest and tax of all the available financing options are equal. And therefore, the investor is unable to select a given financing option. Then now we can say IE, so you can write this one. Earning per share for option 1 is the same as earning per share for option 2. And also earnings before interest and tax for option 1 is the same as earnings before interest and tax for option 2. Yeah, so when the earning per share for the two options are the same, and also earnings before interest and tax for the two options are the same. So that is now the point of indifference. Then another paragraph, we can note that the earning per share for the various financing options, the earning per share for the various financing options can be expressed as follows. The earning per share for the various financing options can be expressed as follows. Can be expressed as follows. Depending on the sources of finance 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 as follows. So a company can, like now, number one, we can have it as all equity finance. All equity finance. So number one can be all equity financed fund. So when the firm is all equity financed, so to compute earning per share will be equal to earnings before interest and tax. Then we subtract just earnings before interest and tax, then 1 minus the tax rate. Then we shall divide by number of the ordinary shares. So if it is all equity financed, earning per share will be equal to earnings before interest and tax. Then 1 minus the tax rate. Then we divide by the number of the ordinary shares. That's now in case it is all equity financed. But it can also be number two. Number two, it can be equity and debt financed firm. It can also be equity and debt financed firm. So if it is equity and debt financed, earning per share will be given by earnings before interest and the tax minus interest. Then 1 minus the tax rate. We also divide by number of the ordinary shares. Also divide by the number of the ordinary shares. Then it can also be equity, debt, and preferred shares. Preferred shares financed firm. Can also be equity, debt, and preferred shares financed fund. So for this one, earning per share be equal to earnings before interest and tax. Subtract interest. Then 1 minus the tax. Then we subtract preference dividends. Then we should be able now to divide by the number of the ordinary shares. Number of shares. So that is now when it is equity, debt, and preference shares finance. So I want us to check one of the question, May 2019, question 1, part B. We can check May 2019, question number 1, part B. May 2019, question number 1, part B. Now check May 2019. So it starts from page 35. When you go to page 35, there is May 2019, question number 1, part B. Question 1, part B. So that question 1, part B, they were asking about this manufacturing limited is considering to raise an extra 10 millions in order to finance an expansion program. To raise an extra 10 millions in order to finance an expansion program. So the company's current capital structure is given as follows. So ordinary share capital, they gave you 20 shillings per value. The amount is 50 million. Reserves, 20 million. Then 14% debenture capital is 20 million. 10% preference share capital is 10 million. So total is coming up to 100 million. So, but from that capital structure, are you able to see ordinary shares? That is equity. Also reserve is part of equity. Then 14% debentures, that is the debt. Then there is also 10% preference share capital. So as per that capital structure, that company is equity, debt, and preference shares financed. When you look at that capital structure, currently it has the ordinary shares. It also has the debentures. It also has the preference shares. So the company is equity, debt, and preference shares financed. So additional information, not number 1. The company is considering raising funds using 2 alternative financing options, namely option 1, to raise all the funds through the issue of the new ordinary shares at par. Then option 2, to raise a half of the funds through the issue of the new ordinary shares at par, and the balance through the issue of the new 12% debentures at par. And finally, the corporate tax rate is given as what? 30%. So required earnings before interest and tax. And at the point of indifference in the company's earnings for each of the financing option. And finally, earning per share at the point of indifference in part B from letter 1 above. So what we should now come up with, is that what we should now come up with. What we should now come up with is that at the point of indifference, earning per share for option 1 must be the same as earning per share for option 2. So that's now the starting point. So we start by analyzing option 1. What will be the equation for option 1? So when it comes to option 1, we say that that company, it is equity, debt, and preference shares financed. Equity, debt, and preference shares financed and financed. It is equity, debt, and preference shares financed. So if that is the case, we have said that earning per share for option 1 must be equal to earnings before interest and tax. We subtract interest, then 1 minus the tax rate, then we subtract the preference dividends. We subtract the preference dividends, and we divide by number of the ordinary shares. Number of ordinary shares. Divide by the number of the ordinary shares. So we start by calculating interest. Earning before interest and tax, we don't know it. It is one of the items we should be looking for. So what we shall start with, we get the interest. So we start off by looking at the interest. So when it comes to interest, go to the capital structure. Are you able to see 14% debenture capital?
Yes.
Yeah, so we simply take 14% of that amount. That's the current interest they are paying. 14% of 20 million. There are 3 zeros at the top. So interest, we get 14% of the 20 millions. Sorry? It is 3.8 millions. Then the next item is supposed to be the preference dividends. We also compute the preference dividends. So preference dividends also got the capital structure. Are you able to see 10% preference share capital?
Yes.
So that total amount is 10 million. So 10% of 10 million. 10% of 10 million. So it will give us 1. The next item will now be number of the ordinary shares. Number of the ordinary shares. So to calculate the number of the ordinary shares, check in the current capital structure. You can see the 50 million ordinary share capital, but the bar value per share is how much? So that one you divide by 20 to get how many shares were there. But again, I want you to check in the option 1. You see under option 1, they have said that to raise all the funds through the issue of what? New ordinary shares at par. Then in the first paragraph, how much were they raising? When you check through the question in the first paragraph. So apart from the 50 million they have in the ordinary share, they want to raise new capital. So the new capital they want to raise is 10 million, but they will do so by issuing another ordinary shares. And the price per share is what? The bar value. So we add the amount to raise is 10 million, but to raise that 10 million, they are issuing shares at par. The bar value, we know it is 20 shares. So when you add them together, we shall now get the total number of the ordinary shares. When you add them together, that's now when we shall be able to get the total number of the ordinary shares. Under option 1, we see that information. Then in the first paragraph, they wanted to raise 10 million. So that is now, so they will give you how many ordinary shares? Sorry? Exactly 3 minutes. So now we come down here, analyze the question. So earnings before interest and tax. That figure, we don't know it. Then we subtract interest, which is 2.8. Then 1 minus the corporate tax. Corporate tax was given. No, not number 2. They gave us what percent? 30% is the same as 0.3. Then now we subtract the preference dividend. So preference dividends, we have calculated it is 1 million. Then we also divide by number of the ordinary shares, which you have seen around me. So now we open the brackets. Now open the brackets. So 1 minus 0.3 will give us which figure? Yeah, so 0.7 we multiply these 2 figures. So it will now be the same as 0.7 earnings before interest and tax. Then we also minus. When you take 2.8, also multiply 0.7. When you take 2.8, sorry, 1.96. Then we also subtract 1 million. Then we also divide by 3. So finally, it will be 0.7 earnings before interest and tax. Then we subtract 1.96 minus 1 million. It is minus and minus. So it will finally give us which one? It will be minus 2.9. Then now we divide by millions. Just coming from so these are negative. So these are negative. So this is now our equation for option 1. This is now our equation for option 1, how to get the earning per share. So you also get the one for option 2. Then we shall equate them, then we cross multiply. Then we make earnings before interest and tax to be the subject. Then we look for that figure. So that one we leave it like that. So let us now go to option 2. We now go to option 2. So that one, we leave it like that. Then we go to option 2. So now we go to option 2. We now go to option 2. So that company will still remain equity, debt, and preferred shares. Equity, debt, and preferred shares. So we use the current capital structure. We start with the current capital structure. So current capital structure, remember it had equity, debt, and preferred shares finance. When you go to option 2, they have said that to raise that 10 million, a half of the funds will come through what? issue of the new ordinary shares, and the balance through the issue of the new 12% debentures at par. So even if now I issue new ordinary share and debenture, the company's capital structure will still have what? Equity, debt, and preference, because that's another capital, additional capital we are raising. We are raising 10 million in addition to what we have. So that company will still remain equity, debt, and what? Preferential. What it determines is the current capital structure. In the current capital structure, they have said ordinary share, preference shares, and debentures. That's why it will be equity, debt, and preference shares finance. I know in option 2, they are using ordinary shares and debt, but overall, the capital structure will still remain equity, debt, and what? Preference shares finance. So to compute the earning per share, for option 2, it will be earnings before interest and tax. We subtract interest, then 1 minus the corporate tax. Then we subtract the preference dividends. Then we also divide by number of the ordinary shares. Number of ordinary shares. Divide by the number of the ordinary. So we start off by computing interest. So in the current capital structure, we have seen interest is 14% of 20 million. Currently, it is 14% of. But now, when you are in option 2, you see when you are in option 2, to raise the new capital, yes, a half will come from new ordinary shares at par, and the balance will be the issue of the new 12% debentures. So the total amount was 10 million. So a half will be how much? 5 million. So we add the other balance, which is 12%. The interest rate is 12% of 5 million. So when you add them together, you now get the total interest under option 2. So under option 2, this is the interest you have been paying. But you want to raise another 10 million. But to raise the 10 million, a half is from the ordinary share. Another half is from debentures. But the debentures now they charge interest at what percent? 12%. So now you add them together. They will give you the total interest. So how much is now our total interest? 3.4 million. 3.4 million. Then the other item is the preference dividends. So these ones are not affected. Preference dividends are not affected. So what we do, we shall simply come up with what was there as 10% of the 10 million. 10% of the 10 million. 10% of the 10 million. Remember it was how much? That one has not been affected. Then the next one is now the number of the ordinary shares. Number of ordinary shares. So currently, you can see currently the ordinary shares. It is 50 millions divided by the bar value, which is how much? Then we add a half of the 10 is what? But they are also being issued at par. They are also being issued at par. So how many ordinary shares are we now going to have at that point? 2.75. So now after that, earning per share option 2 is going to be equal to earnings before interest and tax. So now the interest is 3.4 million. Then 1 minus. Then we subtract the preference dividends, which is and the number of the ordinary shares now are 2.0. So we open the brackets. So this is 0.7. So it will be 0.7 earnings before interest and tax. Then when you take 3.4 multiply 0.7. 3.4 multiply 0.7. Exactly 2.8 minutes. 2.38. So we also subtract the 1 million, then divide by 2.75. So when we simplify, it will be the same as 0.7 earnings before interest and tax. So minus 2.38 minus 1 is the same as 3.38. So we divide by 2.75. So after that, we want now to equate the two equations. After that, so we have said that earning per share should be equal to earning per share for option 2. So the one for option 1 was this one. So it will be 0.7 earnings before interest and tax minus 2.96 minutes. We divide by 3. So that is for option 1. For option 2, you need to make a clear sense. It is 0.7 earnings before interest and tax. A minus 3.38. Also divide by 2.75. So we shall be cross multiply. After we cross multiply, we shall now make earnings before interest and tax to be exact. Then we see how much. So if we cross multiply, those things, remember it will be this way. So it will be 2.75 minutes. This way. And in the brackets of 0.7 earnings before interest and tax minus 2.96 should be equal to. This one will be 3 millions in the brackets of 0.7 earnings before interest and tax. We subtract 3.8. So I want us to open the brackets. To multiply in 1.925 earnings with millions of the earnings before interest and tax. Also, when you multiply this by this, 8.14. Exactly 8.14 millions. So also come at this point. When you take 3 millions, multiply by 0.7, earnings before interest and tax. And the other one should be which one? So you want to make the earnings before interest and tax to be the subject. So making it to be the subject, because this one is smaller than this. Yeah. Because I should have positive figures. So I will cross this one to this side to be positive. When it add 90, the final figure will be positive. Then this one is smaller than that. So I will cross this one to the other side, it becomes a negative. Yeah, so now when this one crosses over this, it becomes a positive of 10.14 million. And now you minus, because this one has not crossed. Then on this other side, these 2.1 million earnings before interest and tax. And now this one crosses. It becomes a negative. It will be negative 1.925 million earnings before interest. So that's now finally what you have. So when you minus this from that, what are we left with? Exactly 2 minutes. Then hii nyingine minus hii kutoka kwa hii 0.7 0.175 millions earnings before interest and tax. So now we make earnings before interest and tax with the subject. So it will be 2 millions divided by 0.175 millions. So that is now what should give us as the earnings before interest and tax at the point of indifference. So it should be able now to give us the earnings before So we want to confirm now in the Roman letter 2. So Roman letter 2, they were asking you to compute earning per share at the point of indifference. So we go back to the 2 equations that we have. For each equation, where there is earnings before interest and tax, we put there what we have calculated and see whether the 2 earning per share will be the same. So we start with the option 1. You already have the 2 formulas. You already have the 2 formulas. You already have the 2 formulas. Whereby earning per share, option 1, you take 0.7. But where there is earnings before interest and tax, you have said is how much? 11.43 like that. Then subtract 2.96 minutes. Divide by 3 minutes. Then also earning per share for option 2. You simply take 0.7 multiplied by 11.43. But this one you subtract 3.38 minutes. Then divide by 2. So you want to confirm whether the 2 items will give you the same earning per share. You want to confirm whether the 2 will give you the same earning per share.
Yes.
So it is giving you 1.0.
160.
Yeah, so all of them are the same. So this is now your Roman literature. So if they're the same, then the earnings before interest and tax is correct. But if you get them different, then your earnings before interest and tax is not correct. So that is what we can have for that part of the quiz. So the time remaining, I will not be able to do another question. So when we meet on Saturdays, last Saturday I forgot. I went to the other class. I had promised them to have a class with them by 11, only to discover that I was supposed to be this side. But now we have agreed with Mwalimu this Saturday I'll be with you people. So we shall meet on Saturday, the alternate one. Last time, sorry? Yeah, sorry? Inakuanga 2 to 4. It is normally alternate. When we have it this week, then it will not be there next week. So we shall have our class on Saturday at 2. So we can stop there for now.